Option contracts transfer the risk from the buyer to the seller of the option contract for what is called a premium. If you are looking for an in-depth explanation for this, please reference my video on what is an options contract. This screen is called an options chain and is available on any broker platform. The platform I am using is called Thinkorswim by TD Ameritrade. Let's first look at the available information on this page. You can see the ticker symbol in the top left corner and the last price that the underlying, or stock price, was traded at. Under the options chain, you will see a list of dates, and each of these rows here represent an expiration series. All monthly option contracts expire on the third Friday of the month and are in this gray color. The yellow expiration dates can be weekly or quarterly contracts. They can also be a non-standard series where the contract only leverages 25 or 50 shares, not the 100 shares as with a standard contract, but for now we will focus on the standard monthly contracts. When you open the expiration series, you can see the strike prices running down the column in the middle. You will see that the numbers increase as they move towards the bottom of the screen. On the left side of the page are the call options, and on the right side of the page are the put options. When we talk about strike prices, there are three references that are used to determine the location of the strike compared to the current underlying value: in the money, at the money, and out of the money. On this chart, the values in blue on the call and the put side are considered in the money strikes. For the call side, we are taking the position that the stock price will go up, so all of the strikes that are listed above the current underlying on this page or lower in the strike prices are considered to be part of the underlying. If you think of a birthday cake, we already baked the cake and now we are hoping for the frosting on top to be our profit. The opposite is for the put side. We are taking the position that the stock will go down in price, so the cake is flipped upside down and the frosting side is now down. Strikes closest to where the underlying is currently trading are considered at the money, and all values not in or at the money are considered to be out of the money. There are two other important things to note here, and those are the bid and ask columns. The bid price is the highest price a buyer is willing to pay, either for the stock or the option contract. If you think of a group of people at an auction and they are bidding up the price, then they are the buyers of the item. The ask price is the lowest price that the seller is willing to sell it for. The seller always wants to get top dollar for their item and does not want to come down too far. The bid-ask spread is the difference between these two, and the midpoint between the bid-ask prices is called the mark price. These prices are the premium for the option contract, and the buyer will pay the premium, which means it is a debit. Think of a debit card, and when you use the card, it pulls the money out of your account as a debit, and the seller collects the premium as a credit, which means you collected store credit. The mark price is the midpoint between the bid and ask prices. The bid and ask prices may become wider or narrower based on demand. The higher the demand, the more competitive the pricing becomes, and the narrower the spread. This will be one of the factors that will help you enter and exit an option contract. The higher the liquidity equals the narrower the spread, which means a higher chance of an order fill at your optimal pricing. Now, looking at this strike price, we can see the bid and ask columns, and if we are the buyer of the option contract, will we be paying the ask price? And if we are the seller of the option, then we are looking at the bid price. The reason for this is because we are buying and selling across from the market makers. They determine the bid and ask prices to create the liquidity. Therefore, if you are a buyer of an option, you will need to pay what the seller is asking. And if you are selling, then you will need to sell it for the highest price the buyer is willing to pay. But where do these prices come from? These values are derived from the intrinsic and extrinsic value of the option. Remember the analogy of the cake? Well, the cake is the intrinsic value of the option contract and only exists within the money strikes. Therefore, any additional value of the contract must come from extrinsic value. The reason the premium is so high, the deeper in the money you go, is because there is more intrinsic value, or the cake gets thicker. I have added the extrinsic and intrinsic value columns to this screenshot so we can see how the numbers from both of these values impact the option's price. In this example, our current underlying is trading at 162.07, and we can choose a strike price of 158. The intrinsic value of the option is the difference between the underlying and the strike based off the current bid price. Since the current bid price is at 162.18, the intrinsic value is 162.18 minus 158, which equals 418. But the premium of the option contract is $6.85, showing that we are paying $2.67 in extrinsic value. The extrinsic value is made up of two components, which are time left until expiration and implied volatility. The higher the volatility and or number of days left until expiration, then the higher the premium. We can see that the intrinsic price plus the extrinsic price gives us the mark price, which is the midpoint between the bid and the ask. As we transition out of the money, the intrinsic value disappears. This is because they carry no value. There is nothing tangible about these strikes. Another thing of note here is that the extrinsic value is highest at the money. Since one part of the extrinsic value is based upon the volatility of the contract, the chances are higher that the underlying will move into the strikes closer to the money, meaning that they are more valuable. The strikes further away from the money are less likely to move in the money, so they are worth less. This goes in both directions, away from the at-the-money strikes, in both calls and puts. As the underlying price moves up or down, even by pennies, the price of the option contract changes, and this will be what affects the value of the contract. Since each contract leverages 100 shares, the price must be multiplied by 100. For the buyer of an option contract, you will be looking to pay what the seller is asking. Therefore, you will be paying the ask price to open the contract. At the 158 strike price, the buyer will pay, or debit, $715 from their account. When the buyer wants to close the contract, they will need to sell to close. If they did this immediately, they would sell the contract back for $655. This would result in a $60 loss on the contract, which is one of the reasons why the width of the bid-ask spread is preferred to be narrower to prevent a large gap whenever the contract is closed. As a buyer of the contract, you are always looking for the contract to increase in value. On the call side, we have seen that the price of the contracts will increase in value as they go deeper in the money. So this means that as an option buyer, at any strike on the call side, you are hoping that the underlying increases because it will move your selected strike price either in the money or deeper in the money, and you will be able to sell it back for a higher price than you paid for it. If you bought a put option, you will be hoping that the underlying decreases and your strike will move either in the money or deeper in the money. Regardless of calls or puts, if you have paid a price for the contract and wanted to sell it back for more money than you paid for it, since the buyer of the contract already paid the premium, their potential profit can be considered unlimited if the underlying moves swiftly in their favor. On the call option, the buyer has the right, but not the obligation, to buy the shares. They can simply allow the value of the contract to increase to whatever point they decide, and then close the contract and take the profits from that value increase. They do not need to exercise their contract to take delivery of the shares and buy them at that strike price. The inverse is true for the put option. As the underlying or stock price is decreasing, the buyer of the put option can allow the value of the contract to increase to whatever point they decide and take the profits. The put option gives the buyer the right, but not the obligation, to sell shares at the strike price. But what if the buyer has no shares to sell? The nice part about options is that the buyer does not need to own the shares to open a contract. They can focus on the direction of the stock to make profits through the increase in value of those put options if the underlying decreases. Along with the changes in the underlying, there are other factors that affect how the option contract prices change throughout the expiration cycle, and that is through the Greeks. For more information on the Greeks, please review my videos on the 4 option Greeks: delta, gamma, vega, and theta. As a seller of an options contract, you are collecting the premium at the bid price. Let's look at an out-of-the-money strike on the call side. The 168 strike has a bid price of $1.94, and with 100 shares being leveraged, the premium collected would be $194. Since the seller collected the premium, this is the maximum dollar amount that the seller can make. And since the seller is taking the opposite position of the buyer's profit can be unlimited, so then the loss for the seller can also be unlimited. So why would anybody want to be a seller? The seller is like an insurance company. They offer protection on your car or home for a premium, and if you never file a claim, then they keep the premium. The same goes for the option seller. If they sell an out-of-the-money option that never goes in the money, they will collect the entire premium. When the seller opens a contract and collects the premium amount, they are hoping for a depreciation in the value of that contract. An example of this would be if you sold a car to someone for $10,000 and knew you had to buy it back in 2 months. During that time, the value of the car drops to $9,000. You would buy it back for $9,000 and net the $1,000 profit. If the seller of the option decides to close the contract prior to expiration, they will buy it to close. To review, a buyer will buy to open a contract and sell to close. The seller of an option will sell to open a contract and buy to close. Regardless of the position you take as either a buyer or seller, when you place the order into the market and the order fills, the contract is open. When you close the contract and you send the order to the market to be filled, it will likely not be with the same person you initiated the contract with. In order to increase your chances of getting orders filled, you should look for the strike prices that fit within your risk parameters for your portfolio and with a high number of open interest. Open interest is the current number of contracts that are open between buyers and sellers at that particular strike price in that expiration cycle. Typically, you will be looking for an open interest above 500 contracts. Imagine you are in a room looking for someone to talk to and you are the only one there. Risk. Regardless of buyer or seller, you are exposing yourself to a potential loss. As a buyer, if the underlying does not move in your favor, you could lose some or all of your premium. As a seller, your risk is either the underlying moving against your short position or being assigned. There are ways for the seller to cap their risk, which will be covered in the video on credit spreads. To limit the losses for the buyer and seller, keeping your risk between 1 and 5% of your account can keep you from losing your entire account on one or several trades that go against you. To determine this, take your total account value and multiply it by 0.01 and 0.05. This will give you a range for your maximum risk tolerance. I hope this gives you a basic understanding of how intrinsic and extrinsic prices affect the option values, along with some principles on the bid and ask prices in regards to the buyer and seller. If you have any questions or would like to see any other videos, please fill it out in the comments section below. Thank you.